On January 20th, 2026, something happened in Tokyo that veterans of global finance had never witnessed before. In a single trading session, Japan's government bond market, long considered one of the calmest, most predictable financial arenas on Earth, convulsed. Yields that typically drift in tiny increments over months leapt dramatically in a matter of hours. Traders who had built entire careers on the slow, steady rhythm of Japanese debt suddenly found themselves staring at screens that no longer made sense, and the shock didn't stay contained. Within hours, pressure rippled into U.S. Treasury markets. American bond yields jumped, high-growth technology stocks sold off sharply. Currency markets turned volatile enough that the Federal Reserve made quiet but unusual outreach to major foreign exchange participants, the kind of move that often signals concern about disorderly trading conditions. The U.S. Treasury Secretary placed an urgent call to Japan's finance leadership as anxiety began spreading across global markets. This wasn't a localized disturbance. It looked, to many analysts, like the early tremor of something systemic, the kind of shift that can alter global power balances in ways no one plans for. And at the same time, halfway across the world, American naval forces were assembling near Iran. A carrier strike group led by the USS Abraham Lincoln, supported by destroyers and advanced fighter aircraft, moved into position. Public rhetoric hardened. Military contingency plans were reviewed and refined. Tensions escalated quickly enough that the possibility of direct confrontation no longer felt remote. Yet, an unexpected paradox emerged. The same financial architecture that has underwritten American global military reach for decades suddenly appeared fragile. Not because of battlefield losses, not because of diplomatic collapse, but because of stress inside the world's debt markets. The uncomfortable question surfaced: could the United States pursue a major military campaign while the financial system supporting its power was under strain? To understand the stakes, it helps to begin in Japan. Japan carries one of the largest public debt burdens in modern history, measured relative to the size of its economy. Its government liabilities exceed twice its annual economic output. In absolute terms, the figures reach into the quadrillions of yen. For years, this seemed manageable. Interest rates hovered near zero. In some periods, investors effectively paid for the privilege of lending to Tokyo. A unique structure made this possible. The Bank of Japan accumulated a vast share of outstanding government bonds. Domestic banks and insurance companies held much of the rest. The system functioned as a largely internal loop. Debt issued in yen, owned primarily by Japanese institutions, supported by a central bank willing to suppress yields. For decades, betting against Japanese bonds became infamous for ending careers. Investors who predicted rising yields were repeatedly proven wrong. But political change altered expectations. A newly elected government announced sweeping fiscal expansion, significant tax reductions paired with record spending commitments, including major defense allocations. The projected budget climbed to unprecedented levels. Markets recalibrated rapidly. Long-term bond yields surged. The 30-year and 40-year maturities saw some of the sharpest moves in years. In just days, borrowing costs jumped at a pace that in other countries might have unfolded over months. The speed, more than the level, rattled confidence. Why does this matter beyond Japan? Because for more than a decade, global investors had relied heavily on what's known as the yen carry trade. The concept is straightforward. Borrow in a currency with extremely low interest rates, historically the yen, then convert those funds into higher-yielding assets elsewhere. U.S. equities, emerging market bonds, real estate, private equity. The spread between cheap yen funding and higher global returns generated steady profit, as long as exchange rates and borrowing costs remained stable. Estimates of the trade's scale vary widely, ranging from hundreds of billions to potentially several trillion dollars when derivatives exposure is included. Precise figures are elusive. When Japanese yields climb and the yen strengthens, the economics of that trade change. Borrowing costs rise. Currency movements erode gains. Investors begin closing positions. To unwind, they sell foreign assets, repurchase yen, and repay loans. If unwinding happens gradually, markets absorb it. If it happens rapidly and in unison, it can create cascading effects. Falling asset prices, margin calls, forced selling, tighter liquidity, further declines. History offers a cautionary example. During the global financial crisis of 2008, shifts in yen funding conditions contributed to tightening credit markets and volatility in global assets. While not the sole cause, the reversal of funding flows amplified stress in an already fragile system. By late January 2026, volatility in Japanese bonds coincided with pressure in U.S. treasuries. Longer-dated American yields approached levels not seen in years. Equity markets, especially high-valuation technology shares, wobbled as investors reduced risk exposure. And this is where geopolitics intersects with finance. Military deployments in the Persian Gulf introduced the risk of supply disruptions in a region responsible for a significant share of global energy exports. Even the perception of instability in such a choke point can influence oil prices, inflation expectations, and bond yields. War is expensive. Sustained military operations require financing, directly through government spending and indirectly through higher borrowing costs, if investors demand compensation for uncertainty. At a time when U.S. public debt already stands at historically elevated levels relative to GDP, rising yields translate into higher interest expenses. Every percentage point increase compounds budget pressures. Markets understand arithmetic. If borrowing costs climb while fiscal commitments expand, whether through defense spending, social programs, or tax changes, investors reassess risk. In previous Middle Eastern crises, U.S. financial markets generally absorbed shocks with resilience. The dollar's reserve status provided insulation. Treasury securities functioned as a global safe haven. But in 2026, the environment looks more complex. Inflation remains sensitive, debt levels are high, global capital flows are tightly interwoven. Stress in one major sovereign bond market can no longer be dismissed as isolated. The result is a strategic dilemma. Escalation abroad could coincide with tightening conditions at home. Financial instability can constrain political choices just as effectively as military deterrence. Leaders may find themselves balancing not only battlefield calculations, but bond market reactions. This doesn't mean conflict becomes impossible. States have historically fought wars under severe fiscal strain, but the margin for error narrows. If borrowing becomes significantly more expensive, policymakers face trade-offs, raise taxes, cut domestic spending, expand deficits further, or scale back ambitions. The deeper reality is this: military power rests on economic foundations. Carrier strike groups, advanced aircraft, precision weapons, all ultimately depend on access to capital at sustainable cost. When bond markets move violently, they send signals. Sometimes those signals reflect temporary volatility. Sometimes they reveal structural shifts. January 2026 may prove to be either a passing tremor or the early stage of a broader repricing of sovereign risk in a world already burdened by extraordinary debt. If the latter, then the question facing Washington is not simply whether it wants to act abroad, but whether the financial system supporting that action can absorb the strain. For decades, American strategy assumed deep and liquid capital markets would always be there to finance global commitments. That assumption may now be tested. And if markets begin imposing constraints that diplomacy and adversaries could not, the balance between financial stability and military ambition becomes one of the defining strategic questions of the era. Because in the modern world, wars are not fought only with ships and missiles. They are also fought with bond yields. In fiscal year 2024, the United States government spent approximately $882 billion just to pay interest on its national debt. That figure was larger than the entire defense budget, which stood at roughly $874 billion. For the first time in modern American history, servicing a past borrowing cost more than maintaining the world's most powerful military. Projections for 2026 suggest interest payments will cross the $1 trillion threshold. That $1 trillion does not build ships. It does not train pilots. It does not fund research into next-generation weapons. It simply covers the cost of money already borrowed. Looking further ahead, the Congressional Budget Office estimates that if current policies continue, annual interest payments could approach $2 trillion by 2035, and those projections assume relatively stable interest rates. If borrowing costs rise, whether because of global bond market volatility, reduced foreign demand for treasuries, or contagion from instability in other major economies, the math deteriorates quickly. Now consider proposed defense expansion. A defense budget in the range of $5 trillion, as some have advocated for 2027, would require substantial additional borrowing, unless paired with major spending cuts or new revenue. Independent fiscal analysts estimate that such an expansion, if entirely deficit financed, could add trillions to the national debt over the next decade, once interest costs are included. Layer on top of that the cost of a major war. Research from academic institutions studying post-9/11 conflicts estimates that the wars in Afghanistan and Iraq ultimately cost several $trillion when long-term obligations like veterans' care and interest payments are included. A significant share of that total was financed through borrowing rather than taxation. And those conflicts were fought against adversaries without advanced air forces, without significant naval power, and without the ability to disrupt global energy markets on a sustained basis. Iran presents a very different strategic profile. It maintains a large conventional military alongside the Islamic Revolutionary Guard Corps, a parallel force structured for asymmetric warfare and regional operations. Its ballistic missile inventory is substantial. It possesses the capability to target U.S. bases and partners across the Middle East. It sits astride the Strait of Hormuz, a choke point through which a significant percentage of the world's oil supply transits. Even limited disruptions in that corridor could spike global energy prices, raising inflation and placing further pressure on interest rates worldwide. Defense analysts have suggested that a sustained high-intensity conflict with Iran could require hundreds of billions of dollars in direct military spending during the first year alone. That estimate excludes long-term reconstruction, expanded veterans care, and broader economic spillover effects. So the practical question becomes unavoidable. How would such a conflict be financed? At present, the U.S. government borrows tens of billions of dollars weekly to cover the gap between spending and revenue. Federal debt held by the public continues to climb. While the dollar remains the dominant global reserve currency, foreign ownership of U.S. treasuries has gradually declined as some countries diversify reserves. If major foreign investors were simultaneously facing domestic pressures, for example, if Japanese institutions needed to raise capital at home during bond market turbulence, they might reduce purchases of U.S. debt or even sell holdings to stabilize their own balance sheets. That timing would be difficult. Funding expanded military operations, while global capital flows reverse would push borrowing costs higher. Higher yields increase annual interest expenses, which then require even more borrowing, a compounding cycle. Several economists have warned about rising sensitivity in global markets to fiscal credibility. When debt levels are elevated, markets react more sharply to policy shifts that signal larger deficits. Investor confidence becomes a strategic asset in its own right. If major sovereign yields climb significantly, carry trade reversals could accelerate. Capital would flow back toward higher domestic returns, shrinking liquidity elsewhere. For the United States, that could mean higher Treasury yields precisely when fiscal space is most needed. History offers instructive parallels. In 1956, during the Suez Crisis, Britain launched a military operation alongside France and Israel to regain control of the Suez Canal. Militarily, the campaign initially succeeded. Financially, it did not. The United States refused to support the British pound as it came under speculative attack and used financial leverage to pressure London. Facing currency collapse, Britain withdrew. The episode marked a turning point in British global influence. In the late 1980s, the Soviet Union struggled under falling oil revenues, mounting debt, and the sustained cost of military commitments. The strain was economic as much as geopolitical. Strategic overstretch compounded fiscal weakness. Even in more recent American history, extended conflict has shaped domestic fiscal politics. After years of war spending, political movements emerged demanding budget restraint. Legislative caps and sequestration measures constrained Pentagon planning for years, disrupting procurement cycles and readiness. Senior defense officials have repeatedly warned that long-term debt poses a national security risk. Military power depends on economic strength. If interest payments crowd out investment in readiness and modernization, strategic flexibility narrows. Today's environment adds further complexity. At the same time, Congress frequently funds the government through temporary continuing resolutions rather than full appropriations bills. These short-term measures prevent new programs from starting on time and create inefficiencies that drive up costs. Reports from oversight agencies have documented contracts increasing in price due to funding uncertainty and delays. When long-term planning is disrupted, procurement becomes less efficient and more expensive, a hidden cost of fiscal instability. All of this converges on a fundamental principle. Financial capacity underwrites strategic capacity. A nation can maintain global military commitments indefinitely only if investors believe its fiscal trajectory is sustainable. Once markets begin questioning that sustainability, borrowing costs rise, flexibility shrinks, and policymakers confront hard trade-offs between domestic priorities and international ambitions. The challenge is not simply whether the United States can win a war militarily. It is whether it can finance prolonged conflict without undermining the economic foundations that support its power. Throughout history, great powers have rarely fallen solely because of battlefield defeat. More often, they gradually discover that the cost of maintaining dominance exceeds their financial means. In an era of elevated debt, volatile bond markets, and interconnected capital flows, that realization, and if it comes, may arrive not with the sound of artillery, but with the movement of yields. Officials inside the F-35 program estimate that roughly 1/5 of their financial management team's time is consumed not by improving efficiency or accelerating production, but by adjusting budgets to function under continuing resolutions. Instead of executing long-term plans, they constantly rewrite them. The Navy faces similar constraints. 3 of its most critical modernization efforts, the DDG-X next-generation destroyer, the SSN-X submarine replacement, and its future air dominance platform, have experienced repeated delays. The Army is attempting to modernize aging armored systems, including replacements for Bradley fighting vehicles and upgrades to the Abrams tank fleet, both of which are nearing the limits of their service lives. Funding shortfalls and uncertainty complicate every step. That is the baseline before adding the cost of a major regional war. Now introduce financial instability into the equation. Imagine Japanese investors rapidly unwinding yen-funded positions, global liquidity tightening, treasury yields climbing as foreign buyers step back, credit markets repricing risk, corporate borrowing costs rising, equity markets losing altitude. In that environment, Congress faces a stark decision: finance military escalation through additional borrowing, risking further stress in bond markets, or delay large-scale action and prioritize financial stabilization. For decades, this trade-off rarely surfaced in serious policy discussions. The United States benefited from the dollar's role as the world's primary reserve currency. U.S. Treasury securities were treated as the ultimate safe asset. There was always demand. There was always liquidity. Trade surplus nations recycled dollars back into treasuries, reinforcing the system. But structural pressures are mounting. International financial institutions project that, under current fiscal trajectories, U.S. debt relative to GDP could rise substantially over the next decade. While comparisons to smaller economies must be made carefully, the United States controls the global reserve currency and possesses unmatched capital markets, elevated debt ratios still influence investor expectations and borrowing costs. Unlike smaller countries, the United States does not rely on an external bailout mechanism. There is no larger sovereign entity standing behind U.S. debt. The Federal Reserve can act as a stabilizing force in markets, but sustained monetization of deficits carries inflation and currency risks. What makes the 2026 scenario unique is the possibility of stress in both the world's largest debtor nation and one of its largest creditor nations at the same time. Financial turbulence in Japan could intersect with U.S. fiscal expansion and geopolitical escalation. Consider three broad pathways. Scenario 1. Strategic restraint. Senior officials evaluate the bond market volatility and conclude that launching a major war during financial instability would amplify systemic risk. Military assets remain positioned as deterrents. Sanctions intensify. Diplomatic channels, whether through regional intermediaries or quiet back-channel negotiations, are given space to operate. Public messaging emphasizes readiness and strength, but large-scale strikes are postponed. Markets stabilize gradually. Borrowing costs remain elevated but manageable. Fiscal pressures continue, but without the shock of wartime spending layered on top. This path requires accepting financial constraints as a strategic variable, not a weakness, but a reality. It prioritizes long-term stability over short-term demonstration of force. Scenario 2. Escalation and financial shock. Military operations proceed. Strikes degrade Iranian capabilities. In response, regional instability drives oil prices sharply higher. Energy inflation spreads globally. Simultaneously, foreign investors under domestic pressure reduce exposure to U.S. assets. Treasury yields rise significantly. Corporate bond spreads widen. Leveraged firms struggle to refinance debt. Equity markets fall into correction territory. The Federal Reserve faces a difficult balancing act: raise rates to contain inflation and support the dollar, or ease policy to prevent financial contraction. Either choice carries trade-offs. Emergency supplemental appropriations expand the deficit. Debt to GDP climbs further. Foreign central banks reduce incremental treasury purchases. To attract buyers, yields rise further, increasing interest expenses and reinforcing deficit growth. A feedback loop forms. Higher borrowing costs increase deficits, which require more borrowing, which pushes yields higher still. Breaking that cycle would likely require some combination of fiscal consolidation, spending restraint, tax increases, or monetary intervention, all politically challenging. Scenario 3. Sovereign shock. In a more extreme case, Japanese bond stress accelerates beyond policymakers' ability to contain it. The Bank of Japan faces competing priorities: stabilize its currency or cap bond yields. Markets test its resolve. Capital repatriation intensifies. Treasury yields rise rapidly. Credit markets freeze. Liquidity evaporates. Money market stress reemerges. What began as sovereign bond volatility cascades into a broader financial crisis. Because roughly a third of U.S. federal spending is financed through borrowing, a sharp rise in yields dramatically increases interest expenses. If markets demand significantly higher rates, the federal government's annual financing needs expand accordingly. In such a scenario, policymakers would confront choices rarely considered in peacetime: aggressive monetary intervention, large-scale fiscal reform, or emergency stabilization measures designed to restore confidence. At its core, the issue is not whether the United States retains military superiority. It does. The issue is whether sustained global leadership can be maintained in an era where financial markets react instantly to fiscal expansion and geopolitical escalation. For most of the post-World War II era, the United States operated with extraordinary fiscal flexibility. Deep capital markets, dollar dominance, and strong foreign demand for treasuries insulated policymakers from immediate consequences. If that insulation weakens, strategic calculations change. Military power ultimately rests on economic credibility. Aircraft carriers, missile systems, advanced aircraft all depend on the assumption that capital will remain available at sustainable cost. When bond markets become volatile, they do more than adjust interest rates. They impose discipline. The defining question of 2026 may not be who wins a battlefield engagement, but whether financial capacity can support prolonged confrontation without undermining the very system that enables American power. History suggests that great powers rarely collapse from a single blow. More often, constraints accumulate quietly, until policymakers discover that choices once considered automatic now carry unacceptable financial risk. And when that moment arrives, strategy is no longer shaped solely by generals and diplomats. It is shaped by markets. Roughly 1/5 of the F-35 program's financial staff time is reportedly spent just reshuffling budgets under continuing resolution restrictions. At the same time, the Navy has pushed back 3 major modernization efforts: the future DDG-X destroyer, the next-generation SSN-X submarine, and its advanced air dominance fighter. The Army is also struggling to replace aging Bradley vehicles and Abrams tanks. None of these priorities are receiving full funding, and that's before even considering the price tag of a potential conflict with Iran. Now imagine this military strain colliding with financial turbulence. Japan's carry trade begins to unwind, global liquidity tightens, US. Treasury yields rise. Borrowing becomes more expensive. Stress in bond markets spreads into credit markets. In that climate, Congress would face a historic dilemma: finance a war through even larger deficits, risking a deeper debt spiral and possible bond market panic, or step back militarily and protect financial stability. For decades, the United States never truly confronted that trade-off. The dollar's reserve currency status allowed vast borrowing capacity. The treasury market was deep and dependable. Nations like Japan and Saudi Arabia consistently reinvested trade surpluses into U.S. debt, keeping rates manageable. But that era may be shifting. The IMF projects that, under current fiscal trends, U.S. debt could climb toward 140% of GDP by 2030, levels comparable to countries that faced severe borrowing stress. The difference is that smaller economies had outside support during crises. Greece relied on the EU and IMF. The UK leaned on its central bank during the 2022 gilt turmoil. If a similar shock struck the United States, who would step in? China's treasury holdings have declined. Japan faces its own fiscal pressure. The Gulf states hold only a fraction compared to total U.S. debt. There is no obvious external rescuer for a $38 trillion and growing obligation. That's what makes this period unique. Financial strain in both the world's largest debtor and one of its largest creditors, combined with rising geopolitical tension. Here's how events might unfold. Scenario 1. Strategic restraint. Leaders review the risks. Treasury officials warn that launching major military operations amid market instability could spark a bond sell-off. The White House opts for pressure without full-scale war, tightened sanctions, covert measures, forward deployment as deterrence. Diplomacy through intermediaries gains space. The conflict is contained. Deficits still grow, but crisis is avoided. This path requires accepting that financial capacity places limits on power. Scenario 2. Escalation. During fragility, military strikes occur and succeed tactically, but retaliation disrupts oil flows, energy prices surge, markets react sharply. Japanese institutions, already repositioning due to domestic bond stress, accelerate U.S. asset sales to stabilize at home. Treasury yields jump, credit tightens, equities fall into bear territory. The Federal Reserve faces a painful choice: raise rates to defend the currency and counter inflation, or ease policy to stabilize markets, risking further dollar weakness. Emergency war funding expands deficits dramatically. Foreign buyers grow cautious. Higher yields increase borrowing costs, which increase deficits further. A feedback loop begins. Scenario 3, extreme shock. Japan's fiscal pressures intensify rapidly. Its bond market destabilizes. The yen swings violently. Large-scale repatriation of capital forces, abrupt selling of overseas assets. U.S. Yields spike sharply. Credit markets freeze. Government borrowing becomes prohibitively expensive. Basic operations, from contractor payments to federal salaries, face strain. In this scenario, military action becomes financially impossible, not due to battlefield limits, but because funding collapses. National priorities would have to be reordered overnight. While such an extreme outcome remains unlikely, the broader constraints are real. Financial markets are reacting. Debt levels matter. Military planning increasingly must factor in economic endurance alongside battlefield capability. Historically, great powers have confronted this tension when fiscal strength weakened: Britain at Suez, the Soviet Union in Afghanistan, empires strained by debt. The United States has largely avoided that question for generations. Now it cannot ignore it. Key indicators to watch include Japanese government bond yields, long-term U.S. Treasury rates, the yen-dollar exchange rate, equity volatility indexes, and corporate credit spreads. These signals reveal whether financial pressure is building or easing. At the same time, diplomatic developments with Iran will hint at whether economic caution is shaping strategy. Ultimately, this moment may mark the end of an era in which the United States could separate military ambition from fiscal discipline. Debt sustainability and financial stability are becoming central to national security itself. The emerging reality is not sudden military defeat, but recognition that financial limits influence strategic choices. In an interconnected global system, instability in one major economy can shape decisions in another. That is the defining shift of this period, and it carries lasting consequences.